Most people think recessions are only about fear, loss, and survival. They see falling markets, bad news, layoffs, and they freeze. Or worse, they panic. They sell at the worst time, hide their money in cash, and promise themselves they will come back later when things feel safe again. Smart investors see the same recession, but they experience it very differently. To them, a recession is not just a crisis, it is a test of discipline, and more importantly, a window of opportunity that does not stay open for long. The first thing smart investors do during recessions is control their emotions. This sounds simple, but it is extremely rare. Humans are wired to react to danger, and a recession feels like danger everywhere. News headlines are negative, friends talk about losses, social media is full of panic. Most people make decisions based on how they feel in the moment. Smart investors already know that emotions are the enemy of good investing. They accept that fear will be present, but they do not let it make decisions for them. They rely on plans made before the recession started, not on feelings during the storm. Another key difference is that smart investors understand that prices falling is not the same as value disappearing. Most people see a stock price drop and assume something is broken forever. Smart investors ask a different question. Has the business itself changed in a permanent way, or is the price just reacting to fear? During recessions, even strong companies with solid cash flow, loyal customers, and long-term advantages can see their stock prices cut in half. Smart investors know this is normal. They focus on the business, not the daily price. While most people stop investing during recessions, smart investors keep buying. They do not try to perfectly time the bottom. They know that almost nobody can do that consistently. Instead, they invest gradually. They spread their purchases over time. This reduces regret and removes pressure. If prices fall more, they buy more. If prices start to recover, they're already in. This simple behavior alone creates massive long-term differences in results. Smart investors also keep cash on purpose before recessions, not out of fear, but out of preparation. Cash is not trash during a recession. Cash is optionality. It gives you the ability to act when others cannot. Most people enter recessions fully invested or over-leveraged. When prices fall, they have no flexibility. Smart investors are patient before the crisis, so they can be aggressive during it. They do not rush to deploy all cash at once. They wait for clear opportunities where fear has created extreme discounts. Another thing smart investors do is focus more on balance sheets than growth stories. During good times, weak companies can survive on hype and cheap money. During recessions, reality shows up. Debt becomes dangerous. Cash flow becomes critical. Smart investors look for companies that can survive without needing outside help. Low debt, strong margins, and stable demand matter much more than exciting promises. They know that survival comes first, returns come second. Most people chase what worked in the past. Smart investors understand cycles. They know that assets go through periods of being loved and hated. During recessions, entire sectors can become deeply unpopular. This is uncomfortable, but it is often where the best opportunities live. Smart investors are willing to look stupid in the short term. They buy when others are embarrassed to even talk about certain investments. Smart investors also lower their expectations during recessions, and this is a strength, not a weakness. Most people expect fast rebounds and quick profits. When that does not happen, they get frustrated and quit. Smart investors think in years, not months. They understand that real wealth is built slowly, especially after major downturns. They are willing to wait while the recovery takes shape. Another critical behavior is that smart investors continue learning during recessions. Most people stop paying attention or only consume panic-driven content. Smart investors read financial reports, study past recessions, and analyze what actually happened instead of what people felt. They look for patterns. They notice that markets recovered before the economy did, almost every time.
They noticed that the biggest gains often happened when news was still bad. Smart investors also avoid trying to feel safe before investing again. Safety is usually an illusion. By the time things feel safe, prices have already moved up. Smart investors accept uncertainty as the price of higher returns. They do not wait for perfect clarity because perfect clarity never comes in real time. One of the most important things smart investors do during recessions is nothing. This sounds strange at first, almost lazy, but in reality, it is one of the hardest skills to master. Doing nothing does not mean being careless or ignoring what is happening. It means understanding that constant action is often the enemy of good results. When markets are falling and news is loud, most people feel pressure to do something. They feel that action equals control. Smart investors understand that most actions taken under stress are emotional, not logical. They know that reacting quickly rarely leads to smart outcomes, so they slow down instead of speeding up. They do not constantly check prices every hour. They do not jump in and out of positions because of headlines or social media fear. They understand that markets move in waves, and short-term noise does not represent long-term reality. While others exhaust themselves watching every red candle, smart investors protect their mental energy. They know that investing is a long game, and emotional burnout is one of the biggest hidden risks. When you are tired, scared, or overwhelmed, you make bad decisions, so they step back and let time do the heavy lifting.
This patience creates a massive advantage. While others are constantly reacting, switching strategies, and second-guessing themselves, smart investors are stable. Stability allows them to see opportunities clearly when they appear. Most people miss good opportunities, not because they are blind, but because they are emotionally exhausted when the moment arrives. Smart investors still have clarity because they didn't waste their energy reacting to every small move. Another critical thing smart investors do during recessions is avoid leverage. Debt feels harmless during good times. When everything is going up, borrowing looks smart, even genius. But recessions expose leverage for what it really is, risk multiplied. Debt removes flexibility. It forces decisions at the worst possible moments. When markets fall and income becomes uncertain, leverage turns pressure into panic. Smart investors understand this deeply. They respect risk more during downturns, not less. They know that survival is the first rule of investing. You cannot benefit from future opportunities if you are forced out of the game today. Many people chase big wins and ignore this basic truth. They want to recover losses quickly, so they take even bigger risks. That usually ends badly. Smart investors accept smaller gains or even temporary stagnation because they know staying alive financially is the real victory. They also understand that recessions are not the time to prove how smart you are. They are the time to prove how disciplined you are. Intelligence matters far less than behavior. You do not need perfect timing, secret data, or complex models. You need consistency. You need to stick to a plan even when it feels uncomfortable. Most people fail not because they lack knowledge, but because they cannot control themselves when fear shows up. Another key difference is that smart investors expect discomfort. They do not wait to feel confident before acting. They know confidence usually comes after results, not before. They accept uncertainty as part of the process. This mindset gives them an edge because they are not surprised by fear. When fear comes, they say, "This is normal. This is what I prepared for."